Hello guys, welcome to another video of CMA US part 1 where we are discussing section A. In this particular video, we are going to talk about accounts receivable. Why do we have accounts receivable? How the treatment is done for the accounts receivable in our books of accounts. Then how the questions will be tested, what type of questions we can expect. So everything we will discuss in and around CMA US accounts receivable topic. Okay. I know this slide looks like this particular presentation looks lengthy. It has some 42 pages, but trust me, you stay with me. It looks lengthy, but it's just like a story. If you see it and connect it with the practical examples that we are going to use, with the help of that, it becomes really easy to understand. Now, once what happened, like in a business, the business owners or maybe the management, they saw that the sales is going up, the accounts receivable is also going up. Going up means what? It is increasing. Both sales and accounts receivable is increasing, but we don't know whether those accounts receivable will convert into actual payments or not. What does that mean? First of all, when do we have accounts receivable? So when companies, they sold goods, when businesses, they sell goods, so they sell goods either on cash or on credit. So when they are selling it on cash, then obviously customer came, they bought the goods, we paid cash to them. So they paid cash to us. So that's what the concept is. But in case of accounts receivable, what happens? Customer came, they bought goods from us, but they told we'll give the money later on. So in that scenario, what I am doing? I am doing what? I am recording that particular sales as accounts receivable debit and sales credit, because I have to record the sales in my books of accounts. So instead of debiting cash, I am debiting accounts receivable. I am creating an asset where I am going to be ensuring that this money is gonna be recovered from the customer. But do you think that always we recover the entire accounts receivable amount? No, sometimes there could be a scenario where we receive only half of the payment, or maybe none of the payment, or maybe some amount of that payment, right? So in order to understand the treatment, accounting treatment in different scenarios, and like what are the rules and everything, we are gonna study this chapter. Now, what will happen if you have account receivable of say $100? So you have accounts receivable of $100. You are anticipating of getting $100 from the customer, but the customer does not has the intent to pay you $100 entirely, and you also know it in your heart that customer is not gonna pay me $100 entirely. So you are recording $100 in your books of accounts. If you're still recording $100 as accounts receivable in your books of accounts, don't you think your asset is overstated? Because accounts receivable is a current asset. Don't you think your balance sheet is overstated? Because of that, what will happen? The investors, people who are interested in investing money in my business, they will have a look at the balance sheet, and they will rely on the figures what we reflect, but they will not know that this accounts receivable amount is overstated, and that will be misleading to them. So that's why we should not over report. But also, if I am over this estimating my losses, I am thinking that okay, customer is gonna pay me $80, but instead of 80 he is gonna pay me instead of 80, I am anticipating he's only gonna pay me $60. So I am overestimating my loss by $20. So in that case, what is happening? I am underestimating my assets. So that is also not correct, because I am not showing the true financial position of my accounts receivable. So that's why in order to solve this problem, this particular chapter comes into the picture, because we should report only that portion of accounts receivable that we are actually gonna collect from the customer. That means that, like, not exact amount, but again the estimate should be close enough to the actual amount collected. Then why this concept exists? Because we record the sales even before the cash is being received. Like, we give the goods to the customer, if we sell off the goods to them, customer hasn't paid any cash to us, but still I am recognizing it as a revenue in my books of accounts. So that's why it is there, like, you know, accounts receivable is there. Then sometimes we give discounts to the customers, so which will reduce the actual cash collected. Then sometimes customer took goods from us, like suppose I am selling these comms, customer bought 10 comms from me, but he is coming back and returning 2 of these comms, and there could be a probability that customer is gonna become a defaulter. He's gonna default the payment. Default the payment means what? He's not gonna pay us back only, he's gonna become bankrupt or insolvent. Okay, so that's why So whenever these concepts, these scenarios are there, so that's why we are studying three concepts very important in terms of accounts receivable. One is net realizable value, second is allowance account, and third is expected credit loss model. What is each of this? We'll study in the subsequent pages. Just a second, I got a text, it's an important one. Okay, yeah, so the three pillars of accounts receivable is given over here. Pillar 1 is net realizable value. That means we should only disclose, only show that amount on our balance sheet that is we are gonna expecting to be collected. That means we are anticipating that okay, acha, this much amount we are definitely gonna collect, or maybe somewhere near to that. Then pillar number 2 for accounts receivable is a contra asset account. What does contra asset account means? Any account like contra asset account means when we have any asset account, from that asset account we are reducing anything in order to arrive at the final amount. So the amount which I am reducing, that amount is termed as a contra asset account. Like the account which we are going to use is termed as a contra asset account. For example, whenever we have asset on our balance sheet, from our asset we reduce the accumulated depreciation and then we get the final book value of our asset. So the accumulated depreciation account is a contra asset account. Similarly, for accounts receivable, from accounts receivable we reduce the allowance account, allowance for credit losses account, and we get the net accounts receivable. So that allowance for credit loss account is what is a contra asset account. Then pillar number 3, expected credit loss model. So what do we have? We anticipate, we expect that okay, this much of credit loss is gonna happen, this much of bad debt is gonna happen. So we have a futuristic approach, and according to that we account for the charges in our books of accounts. So because of these three pillars we get the true economic value of the amounts that should be represented on our balance sheet for accounts receivable. Now, how do accounts receivable arise? So when goods or services are delivered to the customer, payment is expected at a later date. A legal right to receive cash is established. That means we have given any kinds of goods or services to the customer, and payment by the customer is gonna be done at a later date, and we have the title to receive the cash. That means I have a valid invoice receipt or maybe bill of lading, and which acts as a proof. That is, if tomorrow customer is not willing me to pay, I can go in the court and say that I have this bill of lading, I have this customer's purchase order, the customer is liable to pay me. So in that case, an accounts receivable arises. Now, revenue is recognized when company fulfill its performance obligation, not when cash is received. A receivable represents a right to receive cash in the future. That means we recognize the revenue in our books of accounts when a performance obligation is satisfied. We will discuss in detail what is performance obligation when we are studying the revenue recognition chapter. But as of now, just understand that what is happening, that revenue, when do we recognize the revenue? When the performance obligation. That means whatever customer expects from me, I have done that. Customer wanted me to deliver 10 of these comms at their doorstep. I have delivered these 10 of comms at customer's doorstep and the customer has acknowledged it. So that means this is a performance obligation and I have fulfilled it. So then in that scenario, I will recognize the revenue on my books of accounts. And what does receivable represents? Receivables represent a right to receive cash in the future. That means since I have performed my completed my performance obligation, I am obliged to receive cash in the future from the customer. Coming to the valuation of receivable, one is the net realizable value. Receivables are not reported at their gross invoice amount. They must be reported at the net amount expected to be collected, also known as NRV. So in terms of accounting, I'll just give you guys you should say a trick maybe or a cheat code, that in accounting, whenever you see any term which has net associated to it, like net realizable value or maybe net assets, something like that it is given, or net accounts payable. So that means from the main account something would have been reduced, then we have got this net figure. So from the gross accounts receivable, we have removed the allowance account, or maybe we have reduced the discounts or maybe returns, sales returns, and then we arrive at the net realizable value. Realizable receivable value means what? The actual amount of money which we are expecting, or which I am anticipating, which I am assuming that this much amount I am gonna collect from the customer. So that's why we have four particular concepts in the NRV. One is the credit losses. That means the amount of money we are expecting that the customer is never ever gonna pay us. Then the discounts. We have the cash discounts, we have the trade discounts. We should reduce these discounts also from our receivables amount. Then there is sales return from the customer, or if there is any kind of allowances, we are like sales return allowance, or maybe allowance for credit loss, that has to be reduced from the accounts receivable. Then we should also consider variable pricing elements. There could be some kind of contract with the customer that after a certain period of time, if they are gonna pay us X amount of money, then he is gonna get this much amount of discount. So in that case, if some kind of agreement is there where our payment amount is gonna be variable because of a particular activity or maybe a particular event, in that case we should also factor in that particular event, and accordingly we should recognize the accounts receivable in our books of accounts. Then initial recording of receivables. How do we record the receivables? Receivables are recorded at the expected amount of cash to be received. That means the amount of cash I am expecting that has to be received by my business, not necessarily the invoice amount. Customer has come, they have purchased something from me, I have given them an invoice, I have sold this particular com for $100, but I have made the invoice for $100, but later on when customer is gonna come and pay me, I know that this is my old customer and they always bargain for whatever amount we are selling the goods. So the customer will come and say that I will not give you $100, I will just give you $80. So in that case, what happens? In that case, I should recognize only $80 because of my experience, I know that the customer is gonna pay me only $80. Now we have two kinds of discounts. One is the trade discounts, one is the cash discount. So in both of the scenarios, how should we record the accounts receivable? Let's have a look. So trade discounts is what? Trade discounts is applied at the time of sale, immediately at the time of sale. So we record the receivable at the discounted amount and not the full invoice price. So that's what the thing is. So then coming to the cash discount. For the cash discount, what is happening? In the case of cash discount, what happened? That we offer the early payment, maybe like you have heard of early bird discount. So similarly, the customers, if we give them this offer that okay, if you pay me earlier, I will give you this much amount of discount. When I have highlighted over here 2, 10 and 30, this thing, we will discuss this thing in the next slide. So in the cash discount, how do we record the accounts receivable? There is later on two methods. We will have a look. One is gross method, one is net method. We will have a look of that in the subsequent slides. Now coming to the 2, 10 and 30, like in the CMA US examination, wherever you will see the cash discount, or maybe in other chapters also, there could be a probability that you can see this term 2, 10 and 30. That means if you pay in 10 days, you will get a 2% discount. This 210 means what? If you pay in 10 days, you will get a 2% discount, and N30 means what? The full amount is due in 30 days. So that is the terms of the cash discount. So if I pay suppose on the 7th day, I will be able to avail this 2% ka discount. But if I pay on the 11th day, then I will not be able to avail this 2% ka discount. Now accounting for cash discount, like suppose there are two methods, one is gross method, one is net method. Gross method is the one which will be mostly tested on our CMA US examination, and this is the method which we mostly use. So what happens in the gross method? In the gross method, we are assuming that the customer is not gonna avail the discount opportunity, and they are gonna pay us after that. Like for example, in the above one we saw 210. That means the customer is gonna avail the 2% discount if they pay within 10 days. But in the gross method, I am assuming customer is not gonna pay within 10 days. So what will happen? We will record the full sale amount at the invoice price. That means I'm gonna record, like suppose I sold the goods for $1,000, so I will record the entire 1,000 amount as my accounts receivable. Then when customer is paying me early, then I will record that particular discount of $20, because 1,000 ka 2% is $20. Then at that time I'm gonna record the discount, and that discount is recorded as a contra revenue account. That discount is recorded as a contra revenue account. When we will see an example of this and the related journal journal entries, this will be very much clear to you guys. Then coming to the net method. So what happens in the net method? In the net method, from the beginning only we are assuming that the customer is gonna avail the discount. They are gonna pay us within the specified timeline, like within 10 days. And in that case, what happens? I will record my accounts receivable at the reduced amount. That means I will remove the discount, and then I will record just 980 bucks in my books of accounts as my accounts receivable. Then later on, if our assumption is wrong, if the customer is not paying within 10 days, if they pay later than that, then the discount will be forfeited. Okay, so how will be the journal entries and everything? We will have a look at it with the help of the examination example. Then less common in practice but tested conceptually. That means this is very not that much used by the people in practical days, in practical terms, but it is also not tested that much conceptually. Now, one is allowance for discount account. Allowance for discount account is a contra asset account. Why? Because we are removing, or maybe we are reducing something from my asset account in order to arrive at the figure of my net accounts receivable. So instead of waiting to see if customers take discounts, companies can estimate expected discounts upfront and create a contra asset account to reduce the receivables proactively. So what happens? Instead of doing what? Recording the accounts receivable at the full value, companies do what? They anticipate, they estimate the expected discount, and they create a contra asset account, which is the allowance for discount account, in order to arrive at the figure of the net accounts receivable. Here we have the gross method and the net method side by side. With the help of this example, it will be very easy for us to understand. Achha, this 2, 10 and 30 we have used in this entire PPT. So that doesn't mean the same figure will be there in the examination. In the exam, the figures could be different. Like there will be, obviously it will be different. It's not going to be something the same only, 2, 10 and 30. So what does 2, 10 and 30 means? Again, I'm repeating. If the customer pays within 10 days, they will get a 2% discount. Otherwise, the whole amount is due within the 30 days. Now, what is the event? We made a sale of 1000 bucks and this particular term is there. Now first let's have a look at just the gross method. So in case of gross method, I am assuming that the customer is not gonna avail the discount. So I am recording the entire sales at 1000 bucks. Accounts receivable debit, credit, revenue. Now if the customer pays within 10 days, that means they are availing the discount. So in that case, cash will be 980 bucks because they will get 2% ka discount. So 1000 ka 2% is 20 bucks. Then discount amount will be debited into the discount account of 20 bucks. Then accounts receivable will be credited by 1000 bucks. But if the customer pays after 10 days, then in that case, no discount is availed by the customer. And what are we going to recognize? We are going to recognize the cash as 1000 and we will reverse off the accounts receivable by 1000. So net receivable that we will report over there in case of gross method will be 1000. That means we will report the receivables as 1000 in case of accounts receivable. Then coming to the net method. The net method, in the net method, what do? We have the accounts receivable at the net value. That means we account the accounts receivable, record the accounts receivable at 980 bucks and credit the revenue at 980 bucks. That means we reduce the discount and then we record it. Then if the customer pays within 10 days, then obviously same journal entry we will pass, the one which we have passed over here. Like in case of when no discount is taken by gross method, like debit cash and credit accounts receivable. Now if customer pays after 10 days, in that case what we studied above, that their discount will be forfeited. So in that case we are going to debit the cash by 1000, credit the accounts receivable by 980. Why? Because initially we created the accounts receivable with the $980. We cannot credit the accounts receivable with 20 bucks. Because initially we just created the account with 980 bucks. So where will the remaining 20, the extra 20 which we are getting from the customer side will be recorded? It will be recorded in the discount forfeited account. It will be recorded where? In the discount forfeited account. And in the net method, how do we report this particular account receivable? In the net method, the account receivable will be reported as 980 bucks because we are assuming that the discount is already taken. Okay. Okay guys, so gross method or net method, we have understood both, that how the treatment is being done. I hope with the help of this example it's really very clear to you guys that for the net receivables, when it is gross method, we will record the amount assuming that no discount is taken by the customer, but in case of net method, we are assuming that the discount is already taken by the customer and we will reduce the discount amount and then we will record the net amount in our books of accounts. Coming to the credit losses on receivables. Credit loss means what? When the customer is not gonna pay us, when the customer doesn't have sufficient money. So when can we record the credit losses? Credit losses will be in three scenarios. Scenario 1, when the customer has become bankrupt, they have become insolvent, they don't have any money left with them, so they are dissolving their business. In that case, that is termed as a customer bankruptcy and it will be recorded as a credit loss. Second is the payment dispute. Sometimes there could be a scenario where customer says that the invoice amount is different, or maybe the quality of the goods is not good, or they could say that the terms of the contract is ambiguous. In that case, it could be like, a credit loss. Then third, there could be a scenario of financial difficulty. That means customers are experiencing cash flow problems and they are unable to meet the payment obligation. That means they are neither insolvent nor bankrupt nor they are having any payment dispute, but they are saying that they are going to pay the cash later on because they have some issues. So in these three scenarios, that will be termed as a credit loss and we need to account for it accordingly. So credit loss are inevitable in any business that extends credit. Accounting standards require company to estimate and record expected losses proactively, not wait until a customer actually defaults. So what happens if any of these three situations we are seeing that it is happening with any of our customers? So that and therein very moment we should record for that loss, like we should record that particular credit loss or maybe record it in our allowance account, and we should not actually wait till the time customer says and comes and says that okay, hey, I'm not gonna pay you this amount. Moving on to the CECL model, current expected credit loss model. So first of all, this is a modern and a forward-looking approach. What happens in this model? What happens that at each reporting date, what do? We assess the current portfolio of receivables and economic environment. What does that mean? That there will be a date on which we are doing what? We are assessing our accounts receivable. So we are having a look that okay, this is my accounts receivable. How much losses can be there? So we need to estimate the future losses out of our accounts receivable, and in that case what are we gonna do? We are gonna do what? We are gonna estimate our future loss, and we have to make sure that at the end of my year this much amount should be there in my allowance for credit loss account. So when I know okay, this much amount should be there in my allowance for credit loss account, accordingly we will add or maybe reduce the value from my allowance account. So this is a forward looking approach. Why? Because we are doing an estimate, we are doing a estimate for the future. Coming to the what are the factors that are used in CECL estimation, that is the company's expected credit loss. What are the factors? Like how do we anticipate the credit loss? First is the past experience. With the help of the past data, we can see that okay, this is the pattern of this particular customer and they are not gonna pay us amount X percentage of our total amounts receivable from them, the total accounts receivable, they are not gonna pay us. So in that case we can make an estimate. Then having a look at the current condition. For example, nowadays we recently experienced COVID-19. So in case of that, how the customer's payment is gonna be disturbed from their side, like they are not gonna make the final payment to us or maybe the full payment to us. Then again, if the war is, we are anticipating any loss, in that case also we should make the estimates accordingly. Then future forecast, that means we have certain figures, like we are saying that how the market is operating. We know that okay, the oil company is not doing well, and like the oil industry is not doing well, and we have a major customer from the oil sector. So I am anticipating that that particular customer is not gonna pay us the entire money, so we need to account for the credit loss accordingly. Then I am saying that the industry trend, I will see the like the industry in which the customer is operating, and I will see that okay, if that industry is not doing well, then again that is gonna affect the credit worthiness of the customer and the customer might not be able to pay us back. Then lastly, customer risk profile. Then before making that credit loss ka assumption or the estimation, not the assumption, actually the estimation, what I need to do? I need to do what? I need to go and just have a look at the customer's individual profile. That means I should see that how this customer performed in the past, how is the financial health of the customer, whether the customer is repaying other suppliers debt or not. So in that way, all these factors we need to consider when we are doing the estimation of our credit losses. Then what are the methods to estimate the credit losses? The methods to estimate the credit losses are aging analysis. So this aging analysis is the most tested on our CMA US examination. How is this aging analysis done? Don't worry guys, we have a full-fledged example in the further pages and we will discuss that. Then second is the historical loss rate. That means we see in the past how much percentage of a particular receivable was termed as a bad debt, was termed as a credit loss, and on the basis of that we will make our credit loss, like we will make the allowance for credit loss accordingly in the current period. Then probability of default. That is, we will estimate that the likelihood that the customer will default and we will multiply it by the exposure at default, and accordingly we will do what? We will make the changes, like we will record that particular credit allowance for credit loss. Then discounted cash flow. So this is also one of the methods where we expect the future cash flow from the receivables, the accounts receivable from the customer. We discount it to the present value using a discounting annuity table. Again, this is not something which is tested for an examination, but I'm just giving you a overview that suppose 5 years from now I'm going to receive $1,000 from my customer. So is that $1,000 that I'm going to receive 5 years from now, is that 1,000 is today also 1,000? No, the value of that 1,000 will be lower. So I will use my annuity table in order to record that. Then collateral based approach. There could be a scenario that customer has bought something really valuable from me, but the customer was not in the position to pay me cash. So instead of giving me cash, the customer gave me, suppose, one of his delivery vans as a collateral, that hey, later on when I will come and give you the money from the goods, for the goods that I purchased from you, I'm going to take back the delivery van. So in that case I can estimate the recoverable amount from that collateral. I can see that okay, by selling of this delivery van I'm going to receive this much amount of money, so that much amount of money I should record as my accounts receivable. Then comes the direct write-off method. So the direct write-off method, as the name says, direct write-off, that means we directly write off the accounts receivable. So this particular approach is not acceptable under the US GAAP. Why? Because this is not as per the matching principle concept. So as we know, in accounting we follow the matching principle concept. That means in which period we are recording the revenue, in the same period we should record the expenses related to that revenue. Now suppose I'll take one example. Suppose in year one a customer came and he bought goods worth rupees 1 lakh from me, and I am not making any allowance for credit loss for that particular customer. But say in year 2 that customer defaulted. The customer is like, I will not be able to pay off that 1 lakh rupees. That 1 lakh rupees I have recorded in my accounts receivable. Now in year 2 the customer is saying I'm not going to pay that particular amount. So I am doing what? I am directly recording it as a bad debt expense. I am scrapping it off from my balance sheet. So what is happening? Revenue is recognized in year 1, but I am writing it off. I am recording it as a bad debt expense in year 2. So this is not in the same period. So that is why it is unacceptable under the US GAAP. Okay, so where it can be used, this direct write-off method, it can be used under the tax books. Why? Because in tax books this write-off method may be required for some of the purposes. Because what happens, like suppose if you record a bad debt expense, you directly write off your income tax, like bad debts, from your books of accounts. What happens? Your expense will increase. If your expenses increase, your income is reducing. If your income is reducing, you have to pay lesser amount of taxes. And because of this, what happens? Because of this, there will be some temporary differences, like there will be deferred tax asset and deferred tax liabilities in your books of accounts. So that is the thing with the direct write-off method, that why do we not use it, but it can be used sometimes for the tax purposes in order to save the taxes. Now comes the aging analysis, the aging method which we use to estimate the credit losses. So first of all, in the aging method, what will happen in the examination, you will be given different categories of accounts receivable. Some will be 30 days old, some will be more than 30 days old, some will be between 60 to 90 days old, and some will be 90 days old, more than 90 days old. Something like that will be given in the question, and you will be given the balances of accounts receivable for each of this aging category, and it will also be given to you that how much loss we are expecting from a particular aging category. So in that case, we will calculate the expected loss, and the amount of expected loss will be what will be my required allowance balance. Now, allowance for credit loss, what is the particular journal entry? So the purpose of, first of all, the purpose of this allowance account is to create a contra asset account that reduces my gross receivable value to their realistic collectible amount, that is the net realizable value. How much amount we are actually gonna receive, that we are gonna that we are gonna record as our accounts, that we should actually record on our balance sheet. So how we will arrive at that figure? By reducing the contra asset account, and what will be the contra asset account? The allowance for credit loss. Now, allowance for credit loss, it is an estimate and it's not a certainty. The balance is reviewed and adjusted at every reporting date under the CECL model. Now, the core formula, the net accounts receivable is equals to gross accounts receivable minus allowance for credit loss. That is the formula for the calculating the net accounts receivable. And in my balance sheet, it will be shown under the current assets. It will be shown under the current assets. From the accounts receivable, I will reduce my allowance for credit loss and I will get my net account receivable. So allowance for credit loss, it is not a liability, it is a contra asset account. Always remember that. Now, what are the journal entries for recording the credit loss? So the first journal entry is estimating that period end estimate, that how much is gonna be the credit loss. So we will debit the credit loss expense and credit the allowance for credit loss. That is what our journal entry we will pass initially in order to record the expense of the credit loss. Then writing of an uncollectible amount, that means when there is an actual bad debt. So then in that case, we will debit our allowance for credit loss and credit the accounts receivable. I am reducing my accounts receivable, I am reducing my allowance account, both I am reducing. Then if there is a scenario, if I have written off a particular account receivable but later on customer comes and pays me off that money, in that case what will happen? I will record the cash, I will debit the cash and I will increase my allowance for credit loss. We are not going to touch my accounts receivable account. Why? Because for that particular accounts receivable I have already reduced the account, but I have reduced it from my allowance account. So that's why my allowance should come back to my actual amount, like for the amount for which I have written off that particular amount. Now, calculating the credit loss expense. For calculating the credit loss expense, first of all, the allowance for credit loss account is a holding account. So what will happen at the end of each reporting period, we pass a journal entry which we have already seen above, that we debit the credit loss expense. This will be recorded in my income statement, and credit the allowance for credit losses trade receivable account. So this will be recorded where? It will be recorded on my balance sheet. So amount recorded as a credit loss expense is not an independent calculation. Instead, it is the amount required to adjust the allowance for credit loss account to its target ending balance, which represents the total estimated uncollectible amount of all accounts receivable at that period end. What does that mean? That how much amount do we record as an expense? We record only that much amount of expense which we need to add or maybe to adjust in my allowance account in order to ensure that X amount of money should be present in my allowance for credit loss account at the end of the year. How we will understand this? With the help of the example. So first of all, we have been given a T account approach. So as you know, whenever we prepare any account, we just draw a T kind of a thing, and there we record that particular expense, like the credit loss expense, or maybe any account is prepared like that. So how do we account for it? We'll just have a look in this particular slide with the help of an example. Okay guys, so now we will calculate the credit loss expense using the T account approach. So first of all, I will just give you one thing, that allowance for credit loss account always has a credit balance. Allowance for credit loss account will always have a credit balance. Now suppose in the year end, in the beginning of the year, suppose I have, like, let's do with the help of the example, that will be better for us to understand. Now when we have, first of all, example 1, the scenario, the situation when we have a credit balance, that means the allowance for credit loss account looks fine. So the required ending allowance balance is 10,000 bucks, but the existing credit balance is 3,000 bucks. So that means we want it to be 10,000, but at the present time it's 3,000 bucks. So that means I need to increase the amount by 7,000 bucks. So allowance for credit loss amount will be how much? Will be calculated in this way, that we take the credit balance already available, to that I will add my credit loss expense and I will get my required ending balance. So simply, how did we calculate? From my required ending balance, I have subtracted the existing credit balance, and that's how I got the 7,000 bucks. So always remember, when there is existing credit balance, so what we do, from the required ending balance, I will reduce the existing credit balance. So this will be my what? Credit loss expense. And how do I calculate? Debit the credit loss expense and credit the allowance for credit loss. That's how we have calculated it to 7,000 bucks. So simple rules: credit balance already exists, then we have to do what? We just have to subtract it. What we have to subtract? We have to subtract the existing balance from my expected balance. Simple. Now this example is very important. Example number 2, when we have a existing debit balance. Now required ending allowance is $10,000, but existing debit balance is $2,000. So what we have to do? We have to take a existing debit balance. The existing debit balance is of how much? 2,000, and we want a ending balance of 10,000. So in that case, what happens? In that case, in the required ending allowance, we will add the debit balance, whereas over here we subtracted. In the case of credit balance, we subtracted, but in case of debit balance, we are adding the existing balance. Why? It's a debit balance. So my credit loss expense will become how much? 12,000. Repeating guys again. In case of credit balance, we will subtract the existing balance in order to arrive the credit loss expense. But in case of debit balance, we add the existing debit balance in order to arrive at the figure of credit loss expense. Now journal entry will be the same, and just simply we got what? We got our this at the end of the year allowance for credit loss. Now how do we remember that? In case of credit balance, which is the normal scenario, the required ending balance, from the required ending balance we are going to reduce the existing credit balance. In case of debit balance, what we are going to do? We are going to take the required ending balance and we are going to add the existing debit balance. So credit balance is already reaching us, it's already helping us reach the required allowance, while our debit balance is going in the opposite direction. So yeah guys, just to summarize finally, credit balance, if it is there, then we need to reduce the existing credit balance from my required ending balance. If debit balance is there, then we need to add the existing debit balance to the required ending balance. Now, so that's what is given over here in this slide, and the journal entry is also gonna be the same, that in case of debit balance we are gonna add it, in case of credit balance we are gonna subtract it. Now, what is the impact of each entry on financial statements? When we are recording the credit loss expense, is there any impact on my gross accounts receivable? No, there is no impact. No impact is there on my gross accounts receivable. But when I'm recording my credit loss expense, what is happening? My allowance account is gonna be what? My allowance account is gonna be increased, and my net accounts receivable is gonna decrease. Why? Because from my accounts receivable, I am reducing the allowance and then I'm getting the net figure. So if my allowance is increasing, that means I'm reducing more from my accounts receivable. If I'm reducing more from my accounts receivable, so my net AR will be even lesser, and my net income will also decrease. Why? Because my expense is increasing. So my expense is increasing, my net income is reducing. Now, coming to the writing of the uncollectible amount, the writing of the uncollectible account. So what we are doing in case of that, when we are actually writing it off, we are reducing our accounts receivable and we are reducing our allowance account. We have seen already above in our journal entries. Then in case of net accounts receivable, there will be no change. Why? Because suppose previously my accounts receivable, my gross accounts receivable was 100, my allowance account was 20. So 100 minus 20, 80. Now I have written off the uncollectible account of $5. So 100 will reduce to 95, 20 will reduce to 15. So what will be my final net accounts receivable? 80 only. Previously also it was 80. Now also after writing off it is also 80. So there is no change in that. Then coming to the net income. For the net income, there is going to be no change in my net income because we are not recording any expense on our income statement. Then recovery of written off account. In case of written off account is written, there is any recovery. In case of gross accounts receivable, there is no change, but my allowance account is gonna be increased. So because of that, my net accounts receivable is gonna be what? My net accounts receivable is gonna be increased, and there is gonna be no change on my net income. Now, one key important exam insight we should remember, that the right of entry does not affect my net accounts receivable or my net income. Okay, so this thing you should always remember. Over here we have been given a full cycle from sale to write-off. First of all, like it's a continuous process. We sell the goods on credit, then we estimate the bad debts out of it. Then if there is gonna be any default amount, like if there is any gonna unpaid amount, we write off that, and finally we get the recovery or the NRV, or we recover the amount whichever we have written as write-off, or we record the net realizable value. Now the allowance account, the T approach, the allowance account, the T account approach. So on the debit side, first of all, debit side is to reduce it off. So debit side is for writing it off and reducing the allowance balance. The credit side of the allowance account is for the beginning balance, then any recovery of any of the debts, then recording the credit loss expense, and finally the ending balance. So the unknown figure is always solved using the plug method. Balance the T account to find the missing value. That means one side we write the debit side, whatever values are given in the question we will write it off. On the credit side, whatever values are given in the question we will write it off, and then we will use the plug method. Like for example, the recoveries amount is a plug figure. This we have to calculate, and in the question all these figures are given. So all these figures we will write it, and then we will sum total this. From this we will reduce all this, and we will get the recoveries amount. So that is what the plug method is. So again, this is just a repetition of how the credit loss expense is calculated. We determine what should be my ending allowance balance, then we compare it with the current balance. If the current balance is lesser, then obviously if it is a credit balance or a debit balance, so accordingly we do the treatment as we have discussed in the examination, in the example, and we compute the difference, and that particular difference will be termed as a credit loss expense. And what is the journal entry? Debit credit loss, credit allowance for credit losses. Okay, then if the existing balance is a debit, add it to the required allowance and do not subtract it. Already we have seen this on our example on our word file. So again, this is a repetition of the same thing. Coming to the aging method, how do we calculate it? When the number of days, the balances, the loss rate is given. First of all, we multiply the balance with the loss rate in order to arrive at the allowance figure. And lastly, we will sum total it in order to get the required allowance amount. One thing we should remember, the more recent it is, the lower the risk is, the lesser is the loss rate. The older the account receivable is, the higher will be my risk and the higher will be my loss. Now, individual versus portfolio evaluation. Now, when we are evaluating our accounts receivable in order to understand or estimate my credit loss, how should we do the evaluation? So we can do two methods. One can be the individual evaluation. That means we see that okay, one customer ka accounts receivable, and that we evaluate, and for that particular customer I will estimate my credit loss expense. Or I can see the entire portfolio, I can see all the customers all at once, and then I will do the estimate of my credit credit loss expense. So how do we do that? In case of individual evaluation, we do it in that scenario when a particular customer has filed for a bankruptcy, or maybe there is there is an information from outside that this customer has a huge number of debts and he is not able to pay off his debts, and that from that customer we owe a large amount of money, like we are supposed to get a large amount of money from them, a large amount of receivable has been allocated to them. So in that case, we adjust the allowance account immediately. As soon as we get this information, we adjust the allowance account for that particular customer immediately, that particular moment. In case of portfolio evaluation, what happens in case of portfolio evaluation? We do that whenever there is a group of customer who belong from the same industry or they have the similar kind of risk characteristics, that means no signal, and in that case no single receivable has a huge amount of money. In that scenario, we will club them together, we will make a portfolio out of them, and in that case we will do what? We will do the estimation of my this particular thing of my accounts receivable, that is going to be uncollectible, and that we are going to account it accordingly. Then coming to the percentage of sales method. In the percentage of sales method, how do we calculate the bad debt expense? That means we take the current credit sales, and from that we will take a certain percentage of we will multiply it with a certain percentage, and we will remove it, and we will keep it as what? We will keep it as a bad debt expense. So the percentage is derived from the historical experience and industry norms. That means we will derive at this percentage which we are using it to calculate the bad debt expense, using the historical experience from our past experience or whatever the industry is following. So what is happening in this particular scenario, or maybe in this particular approach, the best thing is that we are following the matching principle concept. Why? Because the year in which the sale took place, in the same year we are recording the bad debts for it. Now in this case, it may not produce the correct allowance balance account on the balance sheet. Why? Because we are just basing our judgment on the historical data or as per the industry's this norms. So finding the allowance must always reflect the expected future loss, not just a mechanical percentage calculation. That means we should not just blindly rely on the industry norms and the historical data. We should always have a look at the customer's portfolio also, and we should also use our judgment also in order to ensure what should be my bad debt expense. Now, sales returns and allowances. Sometimes what happens, the customers, they come and buy the goods, but they return the goods that were sold. So in that case, what happens, the accounts receivable also will be reduced. So in that case, what do we create? We create sales return account and allowance for sales return. So sales return account is a contra revenue account, and it reduces my reported income. It reduces my net income, because when I record the sales, from that I will reduce my sales allowance, sales return, and then I will arrive at the figure of net sales. Similarly, allowance for sales return is what? It is a contra asset account which is reducing my reported receivable. Like from accounts receivable, I will reduce the allowance for sales return account, and then my reported receivable will be my accounts receivable will be reported. So both of these accounts, they ensure that the revenue and receivables reflect the expected reality, not the gross account. Why? Because sales return is reduced from my sales account, and allowance for sales return is reduced from my reported receivables, from my accounts receivables. Then factoring of receivables, very important concept. Now I have a business, and in that business I have a lot of accounts receivable that is going to mature over a period of 3 to 6 months. But I am seeing there is an opportunity in the market. My supplier is giving me the raw materials at a very cheap price, but only if I make the cash payment, and I don't have sufficient cash. So what I can do, I can take my accounts receivable and get it factored. Getting it factored means what? I am selling off it's kind of a selling of my accounts receivable to a third party, which is termed as a factor. Maybe it could be a bank, or it could be a financial institution who is willing to take that accounts receivable and give money to me in return of that accounts receivable. Now what is happening? the customer is taking, like the customer has given me, like customer has bought goods from me for 1000 bucks. So I have accounts receivable say of 1000 bucks. I want that 1000 bucks to be encashed. So I am going to the factor, I am going to a third party, I am selling off my accounts receivable to them, and they are just deducting some money out of that, and they are giving me back my like instead of 1000 they are giving me 850 or 900 bucks. So what is happening, I am getting the cash immediately. So this is very helpful. This factoring is a very key liquidity management tool. We are able to manage our liquidity very easily with the help of this factoring method. Now, one is that it improves the liquidity. That means what happens, we can easily get our accounts receivable converted into cash. Then transfer the credit risk. That means my credit risk gets transferred in some of the cases. What will be those cases, we will discuss further. Then because of this factoring, we don't have to borrow money, because if we borrow it becomes a liability, then again we need to pay interest on that. So in order to avoid all these things, factoring helps us a lot, like to getting our accounts receivable factored. Now, what are the types of factoring? One is with recourse, one is without recourse. Without recourse means what? Like suppose a bank is there, this is my account receivable of 1000 bucks, this is my account receivable of 1000 bucks. I have given it to the bank, and the bank has given me my bank has given me say 800 bucks, and it is without recourse. That means now tomorrow if the customer is willing not to pay me, customer is not going to pay me for this 1000 bucks, what I'm gonna do? I'm gonna do what? The customer is not gonna pay me 1000 bucks. It's not gonna impact me. Why? Because now it is without recourse. So it's now the bank's responsibility to recover the amount from the customer. So the entire credit risk is being transferred to the factor, to the bank, or maybe to the person from whom I got this accounts receivable factor. So when I am selling off, when I am getting this accounts receivable factored, I am removing it from my books, and I am not going to record any liability. That means I am going to remove this accounts receivable from my balance sheet, and also I am not going to record any liability for the same. With recourse means what? The seller retains the credit risk. That means the seller has the credit risk, and it must compensate the factor if the customer defaults. That means now if it is the case of with recourse, so what will happen when I am selling this particular accounts receivable to the bank? In that case, I will record a recourse liability. So tomorrow if the customer is not willing to pay the money to the bank will come and recover that amount from me. So that is the difference between with recourse and without recourse. Now, in case of factoring without recourse, the ownership is transferred to the factor. In case of factoring with recourse also, in that case also the ownership is being transferred to the factor. In case of loan, loan is like another scenario which we are comparing with the factoring thing. In case of loan, ownership is not being transferred. Whereas about the liability, for the factoring without recourse, no liability is created. Why? Because who is gonna take the responsibility of collecting the accounts receivable from the customer? The bank is the factor is gonna take that responsibility, and it's their headache. And in case of with recourse, a recourse liability is being recorded. For the loan, no loan. In the case of loan, yes, a liability is being recorded. And in case of recourse, factoring without recourse, there is risk being transferred from our head to the factor's head. That means the credit risk is being transferred. In case of factoring with recourse, it is retained by the seller. It's gonna be retained by me. In case of loan also, it's gonna be retained by the person who has borrowed the money. And here we have some 4 examples given over here in order to understand the concepts more easily. Okay guys, let's have a look at the examples with the help of which our concepts will be pura ka pura cleared. Now, example 1 about the cash discounts. So over here it's been given, sale is given, terms is given, 2, 10 and 30 is given over here, and yeah, so we have to see the 2 scenarios. Scenario A, customer pays within discount period and customer is paying within day 8, because the terms are 2% within 10 days or the entire amount is payable within 30 days. Now, in case of gross method, first we are seeing the gross method, then we will have the net method. So in case of gross method, when the customer is availing the discount, so first is the account receivable debit, sales revenue credit. That is the first entry. Second, gross method, when I am making the payment, when I am making the payment, cash I am debiting with 980 bucks, sales discount I am debiting with 20 bucks, and accounts receivable I am crediting with 1000 bucks. Coming to the net method. For the net method, I have the accounts receivable I will record at 980 bucks, and sales revenue I have recorded at 980 bucks. The net method, at the time of payment, cash will be 980 bucks, accounts receivable will be 980 bucks. Now, coming to the scenario B, where customer pays after the discount period. That means customer is paying me after the discount period. In that case, what I'm gonna do, I'm gonna record the cash at 1000 and account receivable at 1000. Customer is paying me after the discount. But in the case of net method, when the customer is not availing the discount, cash is debited at 1000, account receivable at 980, because that's what we have recorded the account receivable at the beginning over here, starting May. Right, at 980 bucks, account receivable at 980 bucks. So the 20 extra which I am getting, that will go under the discount forfeited account. Now, coming to the example number 2. The example number 2 is about the aging method. So in the aging method, the aging schedule will be given 2 years, and we need to calculate the total required allowance, and the existing allowance is already given to us. So what will be my credit loss expense? From the required allowance, I will reduce the existing allowance, and the balance will be my adjusted allowance that needs to be created. So we will debit the credit loss expense and credit the allowance for credit loss expense. So over here in the aging method, the ending balance of the allowance, what will happen? The expense is the plug figure that we need to reach that balance. The expense is what? The expense is the plug figure. This 3500 is the plug figure. Now, coming to the example 3, when there is a debit balance in my allowance for credit loss account. In that case, what will happen? Let's have a look. Now, the question is given, the scenario has given that the allowance account has an unusual debit balance of 5000. Usually we have credit balance, but we have over here debit balance, and the required ending balance is 43,050 bucks. So the existing balance is 5000. So in how much will be our credit loss expense? In case of debit balance, we add the existing balance to my required ending allowance. So the required ending allowance will be added, and it will be leading to 48,050 bucks. So my adjusted allowance from debit like my adjusted amount will be what? Like the credit loss expense will be how much? 48,050 bucks, and my allowance for credit loss will be 48,050 bucks. But after entry, my allowance balance will be how much? 43,050, because 5,000 is already on my debit side, and my expense is recorded as 48,050. So from this 48,050, when I subtract the 5,000, I will get my ending balance as 43,050 bucks. One thing always we need to remember, that we never subtract our debit balance, we always add it to the required allowance amount. Now lastly, example 4, percentage of sales method. In the percentage of sales method, also we have the debit balance adjustment. Now credit sales is given for the period as 14,000, bad debt rate is given as 6%. So that means what will be my estimated expense? 14,000 into 6%, 840 is my estimated expense. Under percentage of sales method, 840 will be my will be my bad debt expense, and I'm not going to adjust it for the existing allowance balance. Now in the question, if it is asking for the ending allowance balance, and the existing balance is given as 250 already, and my ending balance should be how much? 840. So from this 250, I am going to do what? I am going to add this 840, and 590 will be my credit balance, because I am not required to make this 840 as my what? As my ending balance. I am just asked to calculate the bad debt expense using the percentage of sales method. So please pay attention guys, that in case of percentage of sales method, what do we do? How much will be my credit loss expense? My credit loss expense will be the sales amount multiplied by the bad debt percentage. So 840 will be my credit loss expense. And how much will be my ending balance? Ending balance will be how much? Debit is the 250 balance which is already there. In that I will add my 840 ka balance, and 590 will be my credit balance. So yeah, that's all. We are done with this chapter with the help of the examples and everything. I hope it is clear to you guys. Please have a look at the example 3 and 4 for better understanding with yourself. Okay, now we will have some memory tricks and some summary. So what is NRV? NRV is what amount you actually gonna get. Allowance is like a loss cushion because it absorbs the expected future losses. Write-off means what? That means no new expense is gonna be there. I'm just removing that particular accounts receivable from my books accounts, which I have already recognized in my allowance account. Then older the accounts receivable, the more riskier it becomes. And recourse means what? Recourse is a terminology we use in case of factoring. Recourse means what? That if I have the factoring with recourse, that means I have the responsibility of collecting that particular accounts receivable from the customer. That means I am bearing the credit risk for that. Now, how this topic can be tested in the examination? It can be tested in both the MCQs and both in the scenario based questions. So journal entry can be asked, aging calculations, allowance related thing, then CECL, then scenario based analysis, and MCQs will also be there. So how will this be tested? Application based question can be 70% of the questions can be application based, then 60% can be based on the analysis and 40% on recalling. That means how much you remember the things. What are the examiner twist? How the examiner will confuse you by giving a debit balance in the allowance account, then combining the aging with the percentage of sales method, then including the recoveries and write-offs, how we have to treat that they can include, then asking for adjustment, not the ending balances. The customer, this examiner can ask for the adjustments and not the ending balances. Then mixing the factoring questions with the loan concept, that's how the examiner can confuse us. And what we as a students can make mistakes in the examination. First of all, mistake number one, that we are treating the write-off as an expense. Write-off is not an expense. The expense was already recorded as an expense when we created the allowance account. So again, write-off should not be recorded as an expense in my income statement. Then ignoring the beginning allowance balance, then misapplying the percentages, like when we have the percentage of sales method, then confusing gross method with the net method, then forgetting the contra accounts, that allowance for credit loss, then allowance for sales returns. These are the contra assets accounts that needs to be reduced from my accounts receivable account. Then these are some essential keywords. The meaning and the definition of these are given over here already, which I have already explained earlier. So these keywords we should be very thorough with, and we should understand it really well. Then the critical student point, like the student's confusion point, is that estimating the expense. How do we estimate the expense and how do we determine the ending allowance balance? So estimating expense is one thing, but ending allowance balance is another thing. So that we need to estimate. Okay. So yeah, that is how the students will get confused. And the exam thinking tip, that what should the allowance balance be, that we should start our thinking that how much should be my actual allowance balance, then what should be my required ending allowance balance. In that we should then identify the current position, that whether we have a credit normal balance or an unusual allowance balance, and accordingly we should record what? We should record the credit loss expense. Over here we have been given a full cycle of the receivables, like credit sales happens, then we estimate the allowance, we might write off, we might recover, we might factor in, we might do the factoring, and finally we collect the payment from the customer. So that's all it is given over here. For the exam takeaway, that NRV is the standard. That means we record the accounts receivable at NRV. Then CECL is a forward-looking approach. Write-off is not equal to the expense. Why? Because that write-off we are removing it from my accounts allowance for accounts receivable, which is already recorded as which is already been recorded as my expense. Then aging is like one of the most tested areas from which we should be very thorough, and we have already done over 2 examples for that. And again, what type of questions to expect? MCQs, journal entries, scenario based, like no need to write the journal entries, but in the options journal entries can be given. Then high yield focus areas, that means which topics we should be very thorough with, because they will give us a lot of questions, and with the help of these we are very easily able to solve questions in the examinations. And lastly, when we are doing the revision for this chapter, what should we master at? We should master the T account, we should understand the debit balance trap, then aging calculations and the factoring rules. So I hope this chapter is clear to you guys, and we have given what all should be remembered, what all we should remember from our exams POV. If you have any questions, any doubts, guys, please feel free to reach out to us for this particular chapter or maybe any other chapters as well. I hope this thing was very clear to you guys. Thank you so much.